When I start this conversation, what most people think is, well, I might as well go Roth because I assume taxes are going to go up in the future. This is something I've found many advisors think, but especially a lot of consumers. This is a really big misunderstanding of how effective taxes in retirement versus marginal taxes today work. Before we get into that, I really need to help you understand the difference between Roth and traditional. Traditional accounts are all about deferring tax today. Notice I use the word defer. It's not truly a tax savings because you're reducing your taxable income today to pay that tax in the future. If you make $500,000 today and you say, hey, great, I'm going to put $20,000 into my traditional 401k. What ends up happening is your taxable income goes from $500,000 to $480,000. So you end up saving $20,000 times by your marginal tax rate. So if your marginal tax rate is 32%, then you're going to end up saving just about $6,400 on taxes today. This money is going to get invested. Make sure you do invest it. It does not automatically get invested for you in your IRAs, Roth IRAs, pre-tax 401ks, et cetera. You need to set that up. It is going to grow tax deferred. You're not going to pay tax on your bonds and income or capital gains throughout the time you're investing. And then when you take that money out, you are going to pay income taxes. Regardless if you do Roth versus traditional, you have all of the same income in the year you have today. That deferral comes at your top marginal tax rate. That money is going to get invested, and then you're going to take that money out in retirement, and it's going to fill up brackets. Let's say you retire at 60, you have no other income sources, you take out $100,000. Well, you're going to have the standard deduction. You're going to pay some at 10%, pay some at 12%, pay some at 22%, and you're going to get this effective tax rate. Right now, when you defer, that came at the 32% bracket. In the future, when you withdraw, this is going to come through brackets. Moral of the story with pre-tax accounts are reduces taxable income today, grows tax deferred. You don't pay taxes throughout that time. And then when you withdraw, you pay income taxes on it. The one last thing that you need to know is that you have required minimum distributions on pre-tax accounts. All that means is at a certain age, it's above 70, 72. It just depends on when you were born. You are going to be required to take distributions from these accounts. And so even if you don't need that money because you have plenty of Roth money, plenty of cash on the sidelines, plenty of dollars in taxable accounts, you still have to take distributions from that pre-tax account based on your life expectancy. So the issue here is you're going to have Social Security, you're going to have RMDs, and so both of those get added and can push you into higher brackets. The other thing to note here is on pre-tax accounts, you can time how you take this money out before RMDs. So you can in early retirement try to get some out. You can do Roth conversions, which means paying income tax to move from pre-tax to Roth. And those are two very powerful things to do. So now let's go to Roth. So Roth means putting money in after tax. So you make $500,000 of income, you want to put $20,000 into Roth. Well, how that works is your taxable income stays at $500,000. You are taxed on that $20K, but now that $20K goes into Roth and that grows tax-free forever. So pre-age 59 and a half, all of that's going to grow. You're going to pay no tax. Post 59 and a half, you can take that money out. It does not count as income tax. It does not fill up income brackets. It's a really powerful account because you get this tax-free growth. So the difference between the two, just to remind you, is pre-tax is going to be reduced taxable income today, grow tax deferred. You're going to pay income taxes on the future. And then you do have RMDs that are going to basically force you to take money out. Roth accounts means putting in after-tax dollars that grows tax-free, and then you can use it tax-free in retirement, and there are no RMDs. It's also a great account to inherit because if your kids inherit a pre-tax account, they have 10 years to take that money out, and it's all adding income to them, and they're paying income tax, probably at their highest income earning years. Roth accounts, you can inherit them. You have to take it out within 10 years, but you could just wait till year 10, get a bunch more tax-free growth, and then you don't have to pay income taxes as a child in this highest brackets. So now that we understand how Roth versus traditional works, this is where people start to say, well, you might as well go Roth because you get to pay tax on the smaller amount now versus the bigger amount in the future. But in reality, this is just people not understanding math. So if you said, hey, I have $20,000 to invest today, and you went pre-tax is going to give you that $20,000. If you said, hey, I have $20,000 pre-tax to invest, well, then you'd pay the income taxes, that $4,400 if you're at the 22% bracket. And so it's either going to be $20,000 goes into pre-tax or $20,000 minus 4,400 goes into Roth. And so if you basically have the same tax on this side, the 22%, and the same tax on the end, 22%, it doesn't really matter if you do Roth versus traditional, if you're getting the same return and if you are paying the same tax. Don't sit there and say smaller amount, do Roth because you get to pay tax on the smaller amount. Does not matter. The next thing that we need to think about is really which is better for you. A lot of people will say, well, hey, if you can get 23,500 to Roth or you can get 23,500 to traditional, well, you might as well do Roth because that gives you more dollars invested. That is true if you do not take the tax savings from the pre-tax and go invest it in a taxable account or backdoor Roths or mega backdoor Roth 401k. But that's something people think all the time. But in reality, when we work with people, when they do pre-tax, they take home more money and then we go invest those extra dollars. So you have to factor that part in. How I think about Roth and pre-tax is there's a bunch of variables to think about here. In an ideal world, you start out your career, you're young, you're in the 10, 12, 22, 24% bracket. And those are the years that you do Roth. Because I am somebody who believes taxes are going to go up in the future. That does not mean your tax rate is going to go up in the future. So most of my clients, they're in the 37% income bracket. And so if they choose to do Roth, they're saying, I want to pay tax at the 37% bracket. And then in retirement, when they take money out of, pre-tax accounts, they are going to fill up brackets. So they're going to fill up some at 0, some at 10, some at 12, some at 22, some at 24, some at 32, all the way to 37. To get to a 37% effective tax rate in retirement, you'd have to live off of well over $5 million of income per year. This is just not the reality that pretty much anybody has. That would be such massive pre-tax accounts for that to even happen. And for most of my clients, even if they do pre-tax for a very long period of time, they typically end up retiring at 50, 55, 60, even 65. And at that point, you still have 5 years before you have to take Social Security and 7 years or more before you have to take out RMDs. And so when you get to this window of that 5 years, that's when you get to do Roth conversions. You can sit there and say, hey, great, I'm going to make sure I have no other income flowing through to me, and I'm going to do Roth conversions and fill up brackets, right? And so if you said, hey, I want to do $500,000 of Roth conversions per year, that's going to get you to an effective tax rate of probably 22 to 24%. And so you have to defer at 37, and then you got to convert at an effective rate of 22 to 24%. That is good tax planning. When you think about Roth versus traditional, and I'm only speaking 401k, and I'll explain why in a second, but when you're thinking Roth versus traditional, you are really thinking timing of paying tax. You want to defer when you're in a higher bracket today than you're going to pay in retirement at an effective rate, and then vice versa. So if today you're in a lower bracket than you would assume to be in retirement, then you would rather be in Roth. The reason why I'm only talking about this with 401ks because of the income limits on IRAs. The income limit is so low on a pre-tax IRA that I almost think that the vast majority of people should not use it. So what most of my clients do is they're in this 35 or 37% bracket. They use pre-tax 401ks. They reduce that taxable income today. Then they do backdoor Roth IRA contributions because they're over the Roth IRA income limit. After we've done pre-tax 401k or max out pre-tax solo 401k or a cash balance plan or an HSA, after we run out of all of your pre-tax options, now every dollar is post-tax, because there's no one left. And so would we rather go to taxable account and pay capital gains, or would we rather go to a Roth account and be tax-free? Of course, we'd rather go to a Roth account and be tax-free, especially because most of these people are in 20% long-term capital gains bracket, 3.8% net investment tax, plus state tax. Some of those people are at 13.3 in California. So moral of the story is pre-tax first, run out of all those options, go to Roth through backdoor Roths and mega backdoor Roth 401k, and then we go to the taxable account. This is really how you end up, one, building tax diversification, and two, lowering your effective tax rate over your lifetime. When I think about it, ideal situation is you do Roth in your early years when you're in a lower income bracket. Then when you get into 32, 35, 37, that's when you start to go to pre-tax. Let's say you're 50 years old and you've been doing pre-tax your whole life and you know you're going to work into your 70s. Well, that might change it. And you might say, hey, I have way too much pre-tax money. I'm going to be in way too high of a tax bracket in retirement because I'm a high income earner. I have Social Security. I have all these RMDs. I'm going to end up switching to Roth. You also still want to have a plan for Roth conversions. Because if you're like my clients, you're a high income earner and you're going to be doing, at least 23,000 plus a match to a pre-tax account for 25 or 30 years, that is going to be a huge portfolio of pre-tax dollars. So you are going to need to do Roth conversions. And so again, Roth conversions are all about paying that tax in filling up brackets and moving that money over to Roth to grow tax-free. The best times to do these Roth conversions are early retirement, post a business sale. It could be, hey, you have two dual income people. One of them is going to go into retirement, or one of them is going to take a sabbatical. It could be when you start a new business and your income is low. Those are all really good times to do Roth conversions. And then what a lot of people do is post that business sale. They would say, hey, I have no income, but also we just sold a business. We're doing really well. And they pair a donor advised fund contribution or a large charitable contribution to create more room. So let's say, they want to do a $500,000 Roth conversion in that year. They could also then do a couple $100,000 donor advised fund contribution to help offset some of that Roth conversion and keep them in a lower bracket. We oftentimes have clients who every year we're saying, hey, great, you have some room in 24 and you're also going to do $100,000 of a charitable contribution. We get to fill up the rest of 24 plus all of the room created by the charitable contribution. And that at the end of the day is going to allow you to convert more over. Roth and traditional are both very powerful accounts, and they both are useful at different times. What a lot of people end up doing is they say, hey, I do want a good tax mix and I want some tax diversification. So every year I'm going to split it. This is not the way you want to do it. You want to time it at the right periods of time. Low income years, you want to do Roth. High income years, you want to do pre-tax. Middle income years, 22 and 24, really depends on who you are. If you're in 22 or 24, but you're in your late 50s and this is the highest you've ever been, well, then deferring might make sense. If you're in 22 or 24 and you're in your 20s or early 30s or even late 30s and you're going to start to make way more, well, then probably Roth makes sense for you. All of this tax planning does make a massive difference. You just need to really take all these variables and make them specific for you. Thank you for watching. If you enjoyed this video, please leave a like and go follow my page for more personal finance content. And as always, if you have any thoughts, please leave it in the comments below, and I promise to get back to each individual comment. See you next week.